bad news you can hear is almost infinite now. So the question is, can you take that? I mean, do you really have faith that 10 years, 20 years, 30 years?
You don't have to look far to get doomsday economic forecasts. Simply turn on the television or go to YouTube to see forecasts about what will create the next financial disaster. Great Depression or economic collapse, whether higher interest rates are to blame inflation or public debt. Stay tuned. This is why. Someone is always claiming the next crash is just around the corner, which is why in my job as a professional investor and in my own personal investing portfolio, I like to remember what Peter Lynch has to say about macroeconomic predictions. There's always going to be something to worry about. Make sure to like this video and subscribe to the channel if you haven't already. It's my goal to help you better understand the markets. This is what happens in the stock market because everyone has the brain power to do well in the stock market questions, where they don't have the stomach for it. That's the key organ in the body. There's always something to worry about. I went to school, grew up with a kid in the 1950s. In the decade of the 1950s, there was this big theory that the depression was caused by stock market crash. Totally wrong. We had a big-time depression in 1929 because less than 1% of Americans owned stocks. It wasn't caused by the stock market because the economy went down. The Federal Reserve raised interest rates and we had a big-time depression. In fact, we had several depressions like that from 1850 on. This is only one of about 8 depressions since 1850, but people never understood the adjective in front of depression. You could call it a bad depression, but it was a Great Depression. People weren't buying in the 1950s because they were afraid of another depression, and people were building fallout shelters because they were worried about nuclear warheads and nuclear war. Every one of these little countries has enough warheads to blow the world up 88 times, right? Who's built a fallout shelter? You know we stopped worrying about it and there's always something to worry about. In the 50s, it was depression and nuclear war. The stock market was the best decade this century except for the 80s. Within 2 years, oil was at $14. And now the experts, who are much better paid at this point, are predicting that it will drop to $4 and that we will have a depression. And people believe it once more. I remember when the money supply was too fast. They said we'd have a depression. And now they are saying it'll go too slow. And we'll have a depression. Remember the IDC debt? Many countries have names they can't pronounce, such as Chase Manhattan and Chemical and Manufacturing Hanover. When these countries weren't doing so well, they were referred to as undeveloped or less developed countries. Now they must be referred to as emerging countries. It's like I just learned the other day that the term for someone who is overweight is laterally challenged. You have to say laterally challenged, yeah, but these are IDC debt. They are all going to go bankrupt and we're going to have a depression. Then the Mideast was going on the world. Remember that one? The Middle East around the time of the Arab Spring, people over the weekend become economists and portfolio strategists. You know I'm their bull if they take their lunch on the way to work. In fact, I knew very well the market was going down in October of 1987. Dave Ellison remembers that my first vacation in 6 years was going to take, and we decided to go to Ireland and we stayed there. Here are a few of his most well-known quotes. Be sure to pick something from this investing guru. Lynch has a straightforward investment plan which appears to be at odds with his good investments results. He doesn't try to foretell the stock market's future moves using complicated methodologies. Instead, he invests in high-quality firms with well-understood business strategies at bargain rates. Copy this. Stock familiarity. If you're familiar with Lynch's work, you're probably aware of this well-known mantra. Purchase only what you're familiar with. Because you know more about particular industry segments than an outsider, this can lead to fantastic retail stocks before Wall Street analysts catch on. Peter Lynch's effective strategy was taught to the people through his approachable approach in his best-selling books. One Up on Wall Street, How to Use What You Already Know to Make Money in the Market, and Learn to Earn. It's important to have a big company. Each share of stock you own represents a stake in a genuine company. Small stores are often stronger stock buys than large shops since they have more to gain, according to Peter Lynch's comment from One Up on Wall Street. Enormous businesses make small moves, whereas small businesses make big moves. The present stock price reflects the market's assessment of that company's worth. One of three things must happen if you want the company's worth to increase. The business is growing. Organic sales and store expansion are the best ways for businesses to achieve this. Earnings, sales, and profit margins all increase at the company. The stock is undervalued in the market, or the quality of the stock isn't completely appreciated. Two of these factors are frequently found in great small businesses. They have a great deal of potential for organic expansion. Because their personalization appeals to customers, they can continue to grow for years. Analysts don't pay attention to them. Therefore, there's a good probability they'll be undervalued. Because they can't buy enough shares to have an influence on their bottom line, institutional investors often avoid small-cap businesses for years. A small-cap retailer's stock price might quickly soar once they begin to snap up the limited number of shares. It may be worthwhile to choose the Davids over the Goliaths of retail if you follow Peter Lynch's investing method. This isn't to imply you shouldn't invest in large-cap stores. It just means you shouldn't expect them to deliver the same results. For instance, Home Depot is a dependable business. Its days of tremendous development are numbered, with over 2,000 locations. You must understand which category your stocks belong to in order to know what to expect from them and recognize when their valuation is too rich. Due to their untapped development potential, smaller shops appear to be ideal stock investments. How to stay away from a stock market crash. Lynch defines hot stock and hot industries as those that receive a lot of early publicity and one-up on Wall Street. They may see rapid development at first, but investors will rapidly learn that they lack the profitability, profits, or growth potential to support the hype. If I had to avoid one stock, it would be the hottest stock in the hottest industry, says the author. Furthermore, competitors seeking to profit from a hot product's novelty would eventually enter the market with a knockoff version, deflating the original company's stock value. When a price drops, it frequently drops dramatically. You may soon lose all of your profits if you don't know when to sell. Stock market forecasting is a skill that requires a great deal of experience. Many investors devote a significant amount of time to forecasting the stock market's future performance. They might, for example, try to predict the economy's future growth rate and pinpoint which industries will gain the most. They might, for example, try to predict the economy's future growth rate and pinpoint which industries will gain the most. In contrast, Peter Lynch believes that this is a waste of time for investors. Instead, he recognizes that the stock market's fluctuations are a complete impossibility that cannot be reliably predicted. The stock market is impossible to predict. They are attempting to forecast interest rates. Someone would be a billionaire if they could correctly estimate interest rates 3 times in a row. This is a topic that is really timely right now. In the near term, the stock market's performance could be very unpredictable, with the S&P 500 poised to move dramatically higher or lower in the next few weeks. Rather than attempting to predict the movement of the index, taking a long-term approach and focusing your work on discovering quality stocks could be a better use of your time. Reasons for investing. Investors' motivations for purchasing a certain stock can vary dramatically. One investor, for example, may believe that a company's balance sheet is robust and that its debt levels are low. Another investor might consider the competitive edge of the same company to be the most appealing feature of its investment attractiveness. Peter Lynch believes that your motivations for owning a stock should be straightforward and concise. You shouldn't buy a stock if you can't explain why you owe it to a 10-year-old in 2 minutes or less, according to Lynch. Knowing why you bought a stock and why you still possess, it can help you be more efficient with your money. It may enable you to concentrate on the most critical features of a company in order to assess its risk or reward potential. Thanks for watching. That's all for today. Let me know in the comments section what you think about Lynch's thinking. Subscribe to the channel if you haven't, and make sure that your post notification is turned on more.